What is a holding period? A stock market is a dynamic platform where investors buy and sell financial securities with the goal of generating profits. Investors typically aim to increase the value of their assets over time. Holding period refers to the duration for which an asset or security is owned by an investor before it is sold. In the case of a long position, the holding period is the time between purchasing and selling the asset. For a short position, it represents the time when a financial security is bought by the seller and delivered to the lender to close the position. The longer the holding period, the more potential there is for profit, as the asset's value may increase over time. The holding period is classified into two main categories, long-term and short-term. A financial security held for less than a year is considered a short-term investment. The profit earned from holding an asset until its sale is known as holding period returns. This return depends on the total return generated by the asset. Holding period is also crucial in determining the tax liability for investments, as the tax rate differs based on whether the asset is held long-term or short-term. Short-term holdings are generally taxed at a higher rate compared to long-term holdings, making the holding period significant for tax calculations. There are some rules governing the holding period. For example, when a security or appreciated stock is received as a gift, the donor's holding period is added to the recipient's holding period. This can be advantageous for the recipient. In the case of stock dividends, the holding period of new shares matches that of the old shares. Similarly, gifted stock dividends only qualify for certain tax benefits if held for the required minimum time.
Right now, Kalkine is offering a 7-day free trial on its premium research reports. Get access to data-driven market insights combined with an in-depth analysis on financial markets across the globe. Don't miss it. Subscribe for the free trial now.
The holding period directly impacts both returns and taxation. The longer an asset is held, the higher the potential returns, as the asset may appreciate in value and yield dividends. Investors generally expect more profit as the holding period increases. Calculating the holding period involves starting from the day after the asset is acquired and continuing until the day of its sale. This period is crucial for accurately determining tax obligations. For example, if an investor buys a stock on January 5th, the holding period starts from January 6th. If the asset is sold on December 22nd, the holding period is 8 months, and it falls under short-term investment, subject to higher tax rates. If the holding period exceeds a year, the investment qualifies as long-term, typically benefiting from a lower tax rate.
For more related videos, please subscribe to the channel and click the bell icon to get notifications.